Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/rive to receive the top 10 stocks to buy right now. Hello, everybody. The market is down, and that means that there's some deals for investors right now. I got together with Matt Frankel and Jason Hall to discuss a few stocks that we think are really cheap right now. How are you guys doing?
I'm doing fantastic. I'm excited to be talking about some awesome companies, and I think we probably could have all talked about at least two of these three companies as our choice.
Yes, yeah, I was going to say I'm doing great because it was tough to narrow my list down to just the three stocks that I think are on sale right now.
Yeah, I love this right now because there are so many stocks that you just kind of have to question, like, why is this trading so cheaply? The stock that I picked is sort of a no-brainer to me. It's actually a stock I've never owned until recently, and that's Alphabet, or Google, if you want to go back with their old name. They have a price to earnings ratio of 19 right now and a price to free cash flow of 20. This is at a time when the tech industry is starting to really think about costs a lot more than they ever have. A company like Alphabet has never really had to think about, hey, do we need to pay our engineers? I think their staff is averages about $300,000 a year. Hey, can we cut back on both what we're paying people and the number of people that we have on staff? So I think there's an opportunity to increase margins. And then you think about the moat of their business. I mean, search is the core. And from there, you have all kinds of great businesses that offshoot from that. You have YouTube, where you're probably watching this right now. You have the mail business. They're just collecting first-party data, which is, again, important when Apple is doing their ATT policy, which basically forces companies to have first-party data instead of sharing it amongst each other, like a company like Facebook is doing with some of their partners. So I love the size and the moat and the scale of this business. I don't see anything disrupting them. Look, search is going to be something that we're going to be needing 10, 20, 30 years from now. So why wouldn't Google still be the company that's providing that service? I love it at about a 20 price to earnings or price to free cash flow multiple. So that's why this is a stock that I think is really cheap right now. Matt, do you want to go next?
Yeah, and it's one that I know Jason's a fan of too, because I think I
could have just gone with this one, but you're covering it, so I could pick another one. It's
SoFi, and I did a whole big video a little while ago about how their earnings were so great, so I don't want to go through too much of that. The earnings were fantastic. The company's growing in all the right ways. It's especially growing its financial services products the right way. SoFi started out as a lender, specifically a private student lender. They've pivoted away from that, which obviously that was a good move because no one's paid a student loan in 3 years now. So there's been no reason to refinance federal student loans. So they wisely pivoted to other forms of lending. But the real value is they're building out a banking platform. They recently became a bank by an acquisition. They're building out checking accounts, savings accounts. They have an investment product. They have a credit card. They're trying to be a real bank replacement, which is unique in the fintech space. We've seen a lot of these, what I would call the third place banks. How, like, you have your money, it goes into your Wells Fargo or Bank of America, whatever account, but you have some at, say, Axos or one of the other high yielding banks because it pays a little more interest, but you still have a primary account. SoFi wants to be that primary account. And they're doing a really good job of it. That's the fastest growing part of their business. And what that does, they're actually losing money on that, basically because their customer acquisition cost is so high. But what that does is it creates a natural marketing funnel for all of their lending products where they make the bulk of their money that they don't have to pay for. Now, one of the big drawbacks about SoFi is right now they're funding a lot of their business through high interest debt. Their deposit base is roughly $5 billion. Their loan portfolio is about $12 billion, if I'm quoting that correctly. But the deposit platform just really started to ramp up. I mentioned they just recently became a bank. It's up from about $1 billion at the beginning of the year to $5 billion now. And if they can cover all of their loans with low cost deposits, that's a game changer. And this whole crypto saga that just drove it down another 20%, was up again after earnings. Now it went down because of all this crypto stuff. Because SoFi
the past week it's down like 17 or 18%. It's
right, and the big reason is because they got a letter from a couple of lawmakers that said questioning their crypto practices. They do have a crypto exchange on their platform, and basically the argument is, okay, you're a bank, you can't be offering that stuff. SoFi came out with a letter that said this is an immaterial part of the business. we comply with every regulation. We, educate our customers, which they educate their customers better than any other fintech I've seen. So I think this will end up completely blowing over, regardless of what happens in the crypto market. So I think the market's just valuing this way too low right now.
Yeah, I think you're right. Making that bank acquisition did a couple things. Number one, it gives them, like you said, better control over their future of finding deposits and driving those acquisition costs down. But it also removes a layer of cost, because when you're a fintech and you have a banking partner, you have to pay them, right? They're going to make money as the bank, right? That's why they want to partner with you. So remove that layer of cost, I think, is really valuable. And it's a misunderstood business. And then lastly, I want to hit on the crypto thing again, Matt. One thing that's important, part of the approval for SoFi to acquire that bank was that it is going to divest its crypto business. It's going to split that off and make it part of, it's going to separate it from its business, maybe sell it. And it's agreed to do that. And it hasn't materially changed it. So again, we're seeing lawmakers, frankly, without making this a political conversation, lawmakers maybe just getting some credit for kind of rattling their sabers while we're seeing FTX and these other exchanges collapse over something that's an immaterial risk for SoFi. And to Matt's point, that's made what I thought was already a stock that was on sale, Matt, really on sale at these prices.
Yeah, to be fair, I welcome them digging into the crypto holdings of pretty much any company, including ones that I own. But I think it's going to end up being a non-issue for SoFi.
Probably the case with a lot of companies that have a crypto business, but maybe don't have the same risk as investors are pricing in right now.
Right.
Jason, you had another bank you were looking at. What is that one?
Yeah, so I want to talk about Live Oak Bank, ticker LOB. And first thing I'm going to do, I'm going to show the stock price, because again, this is like so many other stocks that have absolutely been pummeled this year. And this is just over the past 12 months. The stock has fallen almost 70%. So why is the stock falling 70%? Frankly, Live Oak Bank was a little bit stretched. The valuation was a little bit stretched. So what does Live Oak do? Live Oak is in the business of primarily lending to small business. The company's goal is to be America's small business lender. They have some of the deepest data about the health of the small business that you're going to find. So one of the things that they put in their most recent earnings presentation was some data taking a look at things like delinquencies, which is really important. Their non-accruals, things that are really, really important. But then they also talk about the long-term opportunity of what's going on with the small business. Things like, for example, you've got, more than half, nearly 60% of small business owners anticipates selling the business in the next 5 years or selling it 6+ years down the road, right? So they see the opportunity for that transactional volume that's completely removed from where interest rates are. And I think that's really, really important. I want to circle back to this chart one more time to talk about why this is a cheap stock. Okay. It's not cheap just because the price has fallen. It's cheap because the price has fallen and the quality of its business has improved. So its stock price has fallen, again, 67% from the high, but its price to earnings ratio and its price to book value, which are two really important metrics for measuring banks, have fallen more. In other words, over that period, its earnings have actually continued to grow. The value of the assets that it holds on its books have continued to grow. That's the sign of a healthy business. And at this point, you're talking about single-digit price to earnings ratio and a price to book value around 1.7 times for an asset-light bank like Live Oak. I think that is deep value at this point. Now, it could get worse. Let's be honest. If we do see recession, small business activity could slow down. But those are short-term pressures for a business that has proven that it is, over the long term, will continue to take market share and grow.
Jason, this isn't a stock that I've looked at before, but is a big part of their business SBA-backed loans, which are 90% covered by the federal government?
It is. And it's interesting because one of the things management talks about with that is being such a large SBA lender is that it's great because, right, those, like you said, those are guaranteed loans, but it's also a tremendous responsibility to have really good underwriting quality because the SBA is not going to continue working with you if your defaults and delinquencies become problematic, right? So it is definitely a competitive strength, and I think it's one that management doesn't doesn't disregard in terms of the value to the business and making sure that they build on that and let it continue to be a strength.
Yeah, I've been through that process. I think it's actually harder than getting a regular loan. So
yeah,
just throw that out there.
Yeah.
Okay, thank you. Our stocks that we had, cheap stocks right now, Alphabet, SoFi, and Live Oak Bank. Thank you to Jason and Matt. You can find all of us on YouTube. I will put the links in the show notes and have some information on the screen as well during this video. We'll see you here next time.